For over a millennium, the Ptolemaic model of the universe dictated our understanding of the stars. But to make his geocentric model work, Ptolemy relied on a mathematical point called the equant, an arbitrary geometric fudge factor designed to force erratic planetary observations into perfect uniform circles. Modern algorithmic trading commits the exact same structural fraud. Analysts use fixed look-back moving averages, MACD, and relative strength indices to force dynamic, non-stationary markets into rigid windows. These indicators act as modern equants, retroactively fitted to historical noise and requiring constant reoptimization to maintain their predictive illusion. Nicolaus Copernicus eliminated the equant entirely. He replaced it with a system of epicyclets, stacking uniform circular motions to account for the variable speeds of planetary orbits. Without realizing it, he had executed the first geometric iteration of Fourier analysis. To isolate actual Orchid cycles, quantitative finance must adopt this blueprint. Systems have to abandon rigid, lag-based parameters and begin decomposing chaotic price action into true harmonic waves. The most pervasive overfitted parameter in modern finance is the US dollar itself. Building a quantitative model that measures asset prices against an elastic fiat currency is an exercise in economic geocentrism. It assumes a fixed center of value that does not actually exist. Financial engineers solve this limitation through a technique called the change of numeraire. By applying Gersonov's theorem, practitioners mathematically rotate the probability measure of their pricing models, creating a dynamic coordinate transformation filter. This mathematical operation allows the algorithm to switch its reference frame in real time. Instead of pricing assets in dollars, the system rotates to measure them against invariant metrics, like broad liquidity, energy benchmarks, or physical collateral. Stripping away the noise of fiat elasticity exposes the actual mechanics of the economy. By shifting the denominator, the algorithm anchors its capital allocation to the true structural drift of global assets. Before any cycle can be mapped, the input data has to be rendered statistically stationary. Calculating standard integer returns wipes out the long-term memory of a financial time series. Retaining that structural history requires fractional differentiation, which stabilizes the data while keeping its memory intact. Traditional analysis relies on predefined wave filters that dictate the shape of the data before it is even measured. Because financial markets are non-stationary, extracting their true nature requires a tool that can dynamically isolate transient cycles as they occur. The Hilbert-Huang transform acts as an algorithm-driven sieve. Instead of forcing data into a rigid mathematical structure, it performs empirical mode decomposition, extracting intrinsic mode functions directly from the raw price action. Engineer John Ehlers applied this framework to measure the instantaneous phase angle of these extracted waves. By tracking the in-phase and quadrature components on a 360-degree rotation, the system continuously calculates exactly where the market is within its cycle. A steady rotation means the market is oscillating predictably. If that phase angle stutters or stops advancing, it signals a structural shift. The algorithm immediately determines whether an asset is in cycle mode or if it is breaking into a sustained trend. Even after decomposition, fractal market noise remains buried inside the waves. If the system retains too many of these extracted components, it will overfit the model and reconstruct useless historical artifacts. We apply the minimum description length principle as a final information theoretic auditor. This method operates on the premise that the best explanation for a dataset is its shortest possible description, evaluating learning strictly as data compression. The algorithm calculates the code length required to describe the model's parameters and the data it encodes. Any high-frequency signal or boundary artifact increasing this complexity is automatically pruned. This pruning mechanism acts as an uncompromising filter. It systematically discards the spurious data points that serve only to create the illusion of predictive accuracy, leaving behind nothing but the true structural signal. This mathematical purity has immediate applications for tracking structural decay. In 1526, Copernicus drafted an essay outlining how debased currency invariably pushes sound money out of circulation. That mechanic is highly active in the modern digital economy. When we map this debasement anatomy onto decentralized finance protocols, we can analyze automated market makers and stablecoin pools. As collateral quality decays, we observe the exact same phenomenon. Bad collateral drives out good. The Gresham Debasement Index tracks these shifting pool imbalances. By continuously measuring liquidity velocity and algorithmic price deviations, this model can detect the onset of digital capital flight well before a stablecoin depegs. These principles of systemic imbalance extend directly to the physical economy. The same mathematics of co-integration govern agricultural crush spreads, what Copernicus evaluated as the ratio of grain to bread, tracking the structural relationship between raw commodities and their processed derivatives. Because markets are defined by asymmetric price transmission and sudden structural breaks, static models fail. Navigating these environments requires algorithms that adapt in real time, identifying systemic unpegging events before they manifest as market-wide contagion. A quantitative system is only as valuable as its ability to survive out of sample data. Memorizing historical prices generates high backtest returns, but a structurally sound algorithm must navigate future volatility. To verify that resilience, systems are subjected to the scrutiny of banking regulations, like Fed SR 11.7. This acts as a rigorous stress testing framework, actively hunting for hidden fractures and structural vulnerabilities within the code. The process demands the removal of multiple testing bias. By applying combinatorial purged cross-validation and strict minimum backtest lengths, practitioners can mathematically prove whether their generated alpha is genuine or a statistical fluke born from repeated optimizations. Real predictive power is not achieved by forcing the market to fit a flawed theory. It requires dynamic reference frames, data-driven cycle extraction, and rigorous algorithmic pruning to isolate the mechanics driving the global economy.